What's going on with gold, and specifically this points to Switzerland. Gold futures in New York this morning surging to a record high after sources telling us at Bloomberg that Swiss gold bars are unexpectedly facing U.S. tariffs.
A part of the gold market that they thought was going to be exempted, which is sort of smaller Swiss gold bars that are about 100 ounces to 1 kilogram, those are actually now going to face tariffs.
The idea is that a lot of traders here in the U.S. thought that these tariffs on Swiss goods wouldn't be applied to gold.
A whisper of tax.
A tiny tax can move entire markets. Imagine a 1.2% charge on Swiss refined gold bars. On paper, it looks small, just rounding error beside billions in trade. But in practice, even slight frictions at choke points ripple across reserves, bonds, and currencies. Traders adjust spreads. Refiners shuffle production. Reserve managers track collateral by the hour. Because in finance, timing matters as much as size. A single delay triggers new insurance terms, revised warehouse plans, and extra paperwork before gold bars move from vault to vault. This is the hidden plumbing of global finance. Small changes in rules and routes become costs that households and businesses quietly pay months later. Think of policy as a three-track system. Track 1. Targeted tariffs on imports from Asia. Track 2. Incentives for North American production. Track 3. The quiet but crucial bullion corridor, where relief depends on traceability. Most debate centers on tariffs and industry subsidies. But the third track, high-purity bullion, quietly shapes reserves, jewelry costs, and technology inputs. Its importance lies in collateral quality and speed. Domestic mining covers only a fraction of demand. The real buffer comes through Switzerland, home to refineries with unmatched verification, logistics, and insurance networks. If paperwork or costs rise in that corridor, premiums move first, then funding terms. That's why logistics matter as much as mining. Now to the levy itself. Switzerland considers a 1.2% charge on gold refined from outside the G7, unless refiners accept full disclosure. The number is small, but the signal is big. It prices governance into the bar. Apply 1.2% to roughly $6.8 billion in half-year imports, and you get about 82 million. Tiny against global ledgers, but reserves don't run on size, they run on confidence and speed. A slight slowdown makes dealers widen spreads. That nudges yields up, firms the dollar, and squeezes exporters. This is why the levy acts less like a tax and more like a friction coefficient in a system designed to reduce friction. At home, politics split. Mining states push for transparency to boost domestic ore. Jewelry and tech hubs argue for relief to keep costs stable. Finance committees turn commas in guidance notes into market-moving decisions. Who certifies origin, how audits repeat, whether older lots qualify. In Switzerland, the fault line runs through privacy. One camp wants levy revenue for industry relief, another for climate and innovation. But all agree, financial privacy is non-negotiable. Negotiators therefore link bullion terms with concessions on pharmaceuticals or precision parts, weaving careful bargains that avoid sudden shocks. That patience matters. Packages may include temporary exemptions or staged milestones so regulators can adjust if spillovers appear. The design is deliberate. Flexibility is a safety valve. And Switzerland's leverage isn't just gold. It sits at choke points in pharmaceuticals and catalysts, sectors worth tens of billions in U.S. imports. Linking clauses across gold, drugs, and precision materials is a way to spread risk and maximize bargaining power. Here's the key mechanism. In reserve operations, high-purity bars are prized not just for value but for speed of turnover. Add a small tax and tighter checks, and dealers ask for wider spreads. Yields rise a few basis points, the dollar firms, exporters lose pricing room. Over time, a few dollars per ounce becomes a persistent funding signal. The politics simplifies it to fairness for miners versus jobs for jewelers. But the real story is a machine built for stability where even tiny frictions echo across households, clinics, and factories. Swiss refineries built their edge over decades. Skilled labor, armored logistics, deep insurance. Alternatives exist, but they can't match the cluster's scale. That's why decoupling usually means gradual rerouting, not abrupt exits. Markets move in pulses, spreads widen on doubt, narrow when rules are clear, then widen again if deadlines slip. The effect is quiet but real. Costlier money, tighter spreads, and cautious inventories. What seems like a tiny tax reshapes premiums, yields, and even the dollar. Policymakers favor middle ground, partial transparency, limited exemptions, reversible terms. That's not weakness, it's how complex systems stay stable. In global finance, small hinges swing giant doors.